Good morning, VA Rates Nation. Let me turn my cell phone off here real quick. First of all, before I forget, happy Thanksgiving. Yes, it's Thanksgiving Eve, but I hope you're with loved ones. I hope you're safe. I hope you're sound. Enjoy this time of year. We have lots to be grateful for. This is a response to a massive situation that's going on in the VA mortgage world right now. Whether you're a veteran, a civilian, a consumer, a future home buyer, you own a home, this is important stuff. So please listen up, share this video. Please help us make this video become more and more popular. Invite people to this message right now. Yesterday, every single eligible veteran in the United States, that's my understanding at least, received communication directly from the Department of Veterans Affairs and the CFPB, that is the Consumer Financial Protection Bureau, about a warning, okay? A warning. Hopefully I can get all this in here. But they issued a warning together, a concerted effort between the CFPB and the Department of Veterans Affairs in regards to certain solicitations about a refinance that are specifically targeting veterans. Now, I don't like the word targeting because it sounds like if you're a football fan, you're going after somebody with the intent to harm them. I don't think that's necessarily what the warning's about, because we certainly market very aggressively towards veterans. That's our business model. We try to educate on home loan benefits, on other benefits outside of the home loan benefits. We support the military. We wear red on Friday, but we do market mortgage products to veterans. And so what this email, and it'll probably be mailed to people also, we'll post a link to it in this video. What it's basically doing is it is advising veterans specifically when you receive mail solicitation or internet solicitation or telecommunication solicitation. If you're being solicited for a VA loan, specifically a refinance, there are 4 questions that you should pause and ask yourselves and make sure you completely understand the ramifications of the refinance. So I'm going to address those today. We agree with the Department of Veterans Affairs and the CFPB that veterans should be educated and they should know what they're doing when they go to refinance their mortgage. Number 1, does a lower interest rate extend the term of your loan? Guess what? It does. It doesn't have to, but 99% of the time, and don't quote me on that, that's just a statement. The vast majority of the time when you refinance civilians, veterans, FHA, conventional, USDA, a refinance almost always goes back to a 30-year term. So if you've been in your mortgage for 3 years and you have 27 years left on your mortgage and you refinance to pull cash out or just to lower your rate, you're going to extend the term of your loan. Okay? That's normal. You don't have to, though, at low VA rates. We can do odd-termed loans, for lack of a better term. We could do a 27.5-year term. We could do a 28-year term. So if you've been in your mortgage 2 years, you want to lower your rate because you got one of our offers in the mail and you want to refinance? If you are concerned about extending the term of your loan, then by all means, please request a shortened term. Now, between you and I, anyone watching, do you know a single person in the country that paid 360 payments, that would be 30 years worth of mortgage payments, and paid their loan off to zero? Because I don't. I've never met someone who has done that. My parents have their home paid off free and clear, but they refinanced along the way and they paid larger lump sums. They weren't worried about paying it off over a 30-year term. So that's what we're talking about here. Make sure you understand your term in a refinance normally increases. What are the final implications when choosing between a fixed term and an adjustable rate loan? Well, we obviously here at Low VA Rates have no problem standing very tall and transparent here because we educate the heck out of our veterans and our consumers on the differences between a fixed rate and an adjustable rate, the pros and cons between each one. We have videos all over the internet, we have blog posts, and we've done it right here live on Facebook many times. There are benefits and there are costs to both loan types, ARM versus fixed. Educate yourself before you make a decision on which is the best term for you. Number 3, what is your total paycheck for the new loan? Shouldn't be paycheck. I think whoever wrote this today is waiting for payday. What is your total payment? Okay, payment, not paycheck. What is your total payment for the new loan versus the original loan? Okay, and again, that is not what the VA asked. I'm sorry, we kind of threw this together with an immediate reaction to the VA's thing. It's what is your total cost, total payment. So if you add up all of your payments For example, on your 4.25 loan you have today, take your total monthly mortgage payment, multiply that by 360 months if you're on a 30-year term, or 180 months if you're on a 15-year term, and I might show you an example here in a minute. Add up all those payments. That would be the total financing cost of your loan, and then do the same thing on your new loan. Here at Low VA Rates, we have a very strict benefit rule. If the total cost of your new loan, when it's a streamline and you're not taking cash out, is going to exceed the total cost of your existing loan, we won't do the loan for you unless you give us a letter explaining why you would want to do that. And it almost never ever happens on a refinance, okay? We're going to do an example over here in just a minute, okay? Finally, do offers of skipped mortgage payments or receiving cash back at closing through an escrow refund actually add to the total cost of your loan? Yes, they do. Now, on our direct mail marketing, we explain that in the terms and conditions print on the reverse side of your flyer. Also, if you call us up or ever talk to us on the phone, we never suggest that these payments are skipped. Skipping something means it goes away, it disappears. You do, by result of a refinance, normally forego or postpone no more than 2 mortgage payments, but normally somewhere between 1 to 2 payments. That interest that you're not paying your existing mortgage company when they're paid off get tacked on to the back end of your loan. That's one of the costs associated with a refinance. Also, if you're getting solicitations from us or anybody else that suggests you may be entitled to an escrow refund, keep in mind we have no control over that, nor does any other VA lender in the nation. But it is very standard on a refinance, VA conventional FHA, that whatever is sitting in your current escrow account will be refunded to you within around 30 to 45 days of that old lender being paid off. However, we have to create a new escrow account for you, and that is also added into your loan. You can bring that cash to closing if you'd like, so that you can keep your loan balance down, and we educate and converse our veterans on that topic all the time. I'm going to invite you, if you're watching, to start thinking of some questions, because I'm going to finish up here with a quick mathematical example of total payments on existing loan compared to total payments on new loan, and then we're going to finish up. So easy math. Let's just say your mortgage payment on a 5% loan equals $1,000 a month, and you're going to make 30 years worth of payments. That's 360 payments. So that's going to be $36,000. Sorry, $360,000 is what you're going to end up paying for like a $275,000 loan, for example, because of the interest and the time involved to pay that thing off. Now, let's say you're 3 years into your loan, interest rates drop, and you want to come over to, I'm going to do it down here. You want to come and you want to get a 3.25% rate, okay? And you're going to go and get 360 more payments, but your payment's going to drop to, $900. You're going to save $100 a month. Now, 360,000 times 900, as long as that amount is less than 360,000, which I'm telling you right now, it will be, you then are in a good situation. Let's try to do it real quick. 36 times 9, that's 54, 27, 28, 29, 30, 31, 32. I believe if I did my math right, it's $324,000 is what your new loan is going to cost you, even with your closing costs and everything else. Because you're dropping your interest rate from 5 to 3.25, you're borrowing more money, yes. Closing costs. You're extending your term, yes, that's normal. You're still saving yourself in this situation a large chunk of money. That's what that is what they're talking about here in bullet point number 3. Do we have any questions? I think everyone's out buying their turkeys, buying their fryers, making their stuffing. Have a wonderful Thanksgiving. Please share this information, share this video, and refer to it if you have questions in regards to this warning and notification from the VA and the CFPB. Thanks for watching. This is Eric with Low VA Rates.